Welcome to the Ellsworth Advisors monthly update for September. I'm Kelly Keenan. This is Cameron Mealy, and today we will discuss what happened throughout the month from an economic standpoint, from a portfolio standpoint, from a market standpoint, and also our thoughts on kind of what we see coming down the pipe for the next couple months or so. Cameron, why don't you kick us off with some economic news?
I will kick us off with a little economic news, Kelly, but I'm going to do a little bit of revisionist history first.
Okay.
So some I've been thinking about, in the wake of the pandemic. First, let's start, we really haven't seen a significant downturn in the U.S. economy market since 2008, 2009, the financial crisis. So as everybody knows, we've been on 11, 12-year bull run. The music had to stop. You have to reset. Interest rates were historically low for a long time, and eventually there are repercussions. The economy needed to take a step back, needed to recharge. It doesn't just go up. You throw in a 100-year pandemic, lucky for us, you throw in a 100-year pandemic there, and you have zero interest rate environment and almost $10 trillion of government stimulus kicked into the economy. And so when you look at it from an economic perspective, I think in retrospect, we did way too much during the pandemic in terms of putting money out there, easy monetary policy. My concern now is that with inflation running out of control, the Fed is going to go the other way, and they're going to get too aggressive, and really they're going to, not purposely, but everybody likes to talk about when it comes to a recession, a soft landing. Hopefully the Fed's gearing up for a soft landing. I don't think this is going to be a soft landing. I mean, I'll let you comment.
Yeah, no, I agree with what you're saying. I mean, the context of coming out of 10 to 12 years of zero to no interest rate, zero to no interest rate level. So money is free, low inflation. That's not normal. It creates misallocation of capital, and it all comes down to not everybody's going to be hit the same way. Different industries are going to be affected differently, and this could not last forever. Yeah, we're seeing unprecedented rise in interest rates, but that level that we started off of zero going to 4%. 4%
historically isn't.
Wait a second.
Yeah,
4% is for 6% for a 30-year mortgage.
Yeah,
that's who's willing to lend somebody money for 30 years at 6%. I wouldn't do it. So that's only to be expected. Is we need higher interest rates. It's finally it's more of a normalization, and unlike back in the early 80s when interest rates were 15, 16, 17, 18%. Those are high interest rates.
Yeah.
Interest rates, between 5 and 7%, those are not high interest rates.
Normal.
That's more normal. You're going to get a better allocation of capital. So if you did not see this coming as a business owner, as an entrepreneur, as a corporation, that, hey, you can't assume zero interest rates forever or super low interest rates forever, you have to adjust your businesses. The businesses that, have healthier balance sheets, that, have plan for this or assume that this was going to happen at some point in time, they're going to get through this fine. Mm-hmm. And soft landing, hard landing, some industries are going to get hit really hard. Some businesses are going to get hit really, really hard. Other businesses are going to see slowdowns, see softness in their businesses, but they're going to survive. And going back to the pandemic thing, that's where really, typically when you go into like a recession or one of these adjustment periods, go back to 2001, 2002, or 08, 09, you saw a lot more excesses in businesses in general. Yep. More companies kind of getting over their skis, getting more aggressive with inventory building, getting more aggressive with building out, spending more money, bringing on more debt.
This was more of a valuation issue.
Yeah, because of the pandemic, businesses have been constrained. They can't really get out over, they couldn't have gotten out over their skis. So I think for most businesses, it's going to be, slower years, but not devastating years. Yep. So you're going to have different effects in different places. Your more speculative investments are really going to feel the most pain because a lot of those speculative investments are a result of zero interest rate environment. What's going to, on the good side from a saver standpoint, from an investor standpoint, is now we can actually
finally get some yield.
Actually get some yield. We're buying T-bills at 4%. only going out 8, 9, 10 months. When's the last time you get 4% in anything without having to go out 10, 20 years on low-grade debt or questionable debt? So there's goods and bads. We knew this was going to happen at some point in time. You never know the degree, how the market's going to adjust for it. What we do know ultimately is, well-run businesses that are producing things that people want with real cash flows, real earnings, they're going to get through this fine. Yeah, the market's down, but for every big market drop, the market never stays there and just kind of flatlines for years or months on end. It's going to be, we're going to hit a low. Things will start marching back up, but the economy is still going to get worse. The market's definitely going to move.
Well, and that's what
before the economy. That's for sure.
If we look at this Fed tightening, how does it manifest itself? We've already seen these are numbers that we've already talked about. First quarter GDP was down 0.6%. Second quarter GDP was down 1.6%. That's on an annualized basis. The Bureau of Economic Analysis just confirmed on September 30th that 1.6 negative number with their third revised estimate. The interesting thing is the Atlanta Fed's GDP Now model, and this is as of October 3rd, they're projecting a 2.3% annualized increase in GDP in the third quarter. I don't see it.
It'll be interesting. They may miss the mark a little bit.
Yeah.
Could we be positive for third quarter? I wouldn't doubt it. The one thing we always talk about...
We could be, but I think a positive would be a blip.
Right. Well, we always talk about GDP, gross domestic product, but now what's starting to pop up is gross domestic income. And, back in business school, we learned, okay, GDP, GDI, basically the same. So you kind of like, who cares about GDI? Because it's always GDP.
Everybody quotes GDP.
They're ultimately the same in the long run. But what we've seen, like the first two quarters, GDI was actually positive.
Yep.
So, okay, and that's gross domestic income. Okay, the reality that trillions of dollars were actually thrown at businesses and consumers, unlike in 0809 when money was created but went into the banking system
to shore them up.
This time it went into the real economy. That's logically that makes sense. That's what's skewing the GDI numbers. So, okay, is GDI maybe righting itself, and you're getting kind of a convergence of the two that could result in a positive third quarter, maybe positive fourth quarter. But what the assumption is okay, they're still slowing to come.
Yep.
And
let me show you where that slowing is coming. So this is what we talk a lot about the unfilled jobs, the JOLTS, jobs left to fill. So job openings, this is from the Bureau of Labor Statistics as of October 4th. August job openings decreased to 10.1 million. That's down 1.1 million or 6.2%, since July. In July, we talked about 11.2 unfilled jobs. Now we're down to 11.1. I'm sorry, 11.2 down to 10.1. These jobs, they weren't filled. They're gone.
Right.
People aren't hiring right now. People have started slowing down. I mean, where do you really see that? So this is by intelligence. These are companies that have announced layoffs or hiring freezes recently. Credit Suisse, Gap, Bristol Myers, Amazon, Kazoo, Wayfair, Peloton, Alibaba, Siemens, Twitter, Spotify, Netflix, CVS, Tesla, Facebook, Unilever, Carvana, Zillow, good old, Stryker, medical distributor, products company. So what did we see in there? We did see a lot of tech companies, a lot of new, market economies, a lot of companies that had, significantly high valuations. They're investing for growth. They're funding losses. Now at these higher interest rates, they got to pull back. But I mean, you're seeing companies, Credit Suisse. Credit Suisse is a 150-year-old, investment bank.
Right, but they've had some issues lately.
They have, but Bristol Myers Squibb. I mean, you are CVS. You're talking about CVS has done a lot of acquisitions, but the point being is that we're definitely seeing companies pulling back. They're pulling back on hiring. They're pulling back on investing in inventory. They're pulling back kind of on everything. I think everybody's retrenching, expecting, some more pain and preparing themselves for it.
Well, the reality of that is what we're going to see third quarter earnings. A lot of companies are definitely going to be lowering expectations, and everybody's going to be doing it. So if you're a corporate leader, a CEO, CFO, you know what, we might as well lowball this. Everybody else is. We're not going to look any worse than anybody else, so let's bring down the expectations. And that's what that's the part of the cycle. We're in that game. When markets start going, when all markets are going up, as a CEO, you don't want to look like the worst guy, so you kind of press the limits on expectations. Now when everybody's going down, now you can start lowering that bar. Yep. Which only brings up upside surprises as we go further down the line. 2-3 quarters from now, hey, they brought expectations down so low that now warrants upside surprises. Yep. Or revisions to the upside. That's where you're going to see a market truly turn. And there's that dynamic that's going to start playing out this quarter.
Definitely.
But the reality is how much of that's already priced in. A lot of it definitely is priced in the market, but we're still in a bear market. We saw rip your face off rally these last 2 days, similar to what we saw back in July. These big moves in the stock market, even though it's been down a lot. And the reality is the biggest rallies do come in bear markets where you have these huge run-ups, but then they tend to fail, and once again back down to the lows again. So we revisited, it's the second time we revisited the lows of June. I'm sure we'll revisit them a couple more times, before this is over. Very well, I would not be surprised, kind of expect we will probably go lower, the ultimate lows of this whole cycle. And I've said this before, we could be off 35-40% from the highs, but also, like I mentioned, it's not like we're going to stay down there for very long. Yeah. You're going to get, we're going to hit.
And those are highs after an 11-year run.
Yeah,
where everybody still should be up if you were in a proper portfolio.
Yeah, you're going to get capitulation. The market will start recovering. It's not going to hit new highs anytime soon, but definitely, be making money. That's for sure. Yeah. So that's kind of the environment we're living in, and I think ultimately to break the downward trend, it's all about interest rates, inflation and interest rates. You need to have real interest rates, meaning your interest rate is higher than the inflation rate. So if the Fed funds rate's at 3.5 and inflation's at 8, those two need to converge. I don't think they're going to converge at 8-9% or 7%. No, but the reality is inflation will soften. It's still going to be higher than 2%. But I think we're going to be running higher inflation for a number of years in that 3-5% range, which means rates will probably end up settling out in that, that
well, and we're definitely going to see it. I mean, if you
that's
look,
when the market goes back up.
The Fed has 2 more meetings this year in November and December.
Yep.
This is my last point. This is from Reuters. In a Reuters poll, over 70% of economists predicted that the central bank would hike the Fed funds rate by 0.75% in November. I think that's kind of the expectation. They go further. The survey also said a 50-point increase in December is likely. So that would take the Fed funds rate up to only, historically speaking, only 4.5%.
Yeah,
but that's 450 basis points in 1 year. That's what concerns me, is that the Fed is going to be very aggressive.
Right.
The economy will soften. We will be in a recession. And next year, end of second half of next year, you might see the Fed cutting rates again.
It's possible. It depends on how quick the inflation comes down. But I think the reality is once they get to that 4.5 level or in that range, that's when they're really going to pause. I think they want to get there. Let's wait and see.
I'd like to see
because
them pause.
They know it's not a huge nominal number.
I'd like to see him pause right now and get a couple more months of inflation data. But Jerome Powell, the chairman of the Fed, he's as hawkish as we've ever seen.
Right.
And so they're going to do, they're not looking at it. They don't work for the American people. They work to keep inflation. I mean, they're not thinking about who's retiring tomorrow and whose 401k is getting hurt. Right. I mean, they're thinking about what is best for the long term of the economy vis-a-vis growth and inflation.
Right.
And that's going to be their focus. I'm afraid they're going to go a little too far. We'll see what happens, and we're certainly prepared, for a slowdown, and that's the way we're managing accounts.
Yeah, we don't know how it's going to turn, and once again, the market will bottom long before the economy bottoms out. Inflation numbers are lagging, so that's the other reality is do we actually have to see inflation and interest rates get to that dynamic, or is it a matter of approaching it, or it looks like we're getting there? That's when you truly get back into an upward trend, a long-term upward trend versus just rallies and so forth. Let's jump into what happened. It was a very ugly month. September historically has been known as one of the worst months of the year, and They earned their reputation this month. October tends to be pretty volatile, but from an absolute return standpoint, September tends to be a little bit worse. So in September, Dow Jones was down 9.6%. The S&P was down 10%. NASDAQ was down 11. Russell 2000, which is small caps, 10.3, so kind of in the middle. Usually small caps are a little more volatile. It looks like the worst is probably behind them. International markets, developed world down 10%, emerging markets down 11.8%. So year to date through September, that pretty much put everybody into bull market status, bear market status. Bear market meaning being 20% off your highs. Year to date, the Dow is down 20.95. The S&P down 24.8, NASDAQ down 32.4, Russell 2000 25.9, international markets, developed world 28.9 to the downside, emerging markets, the same thing, down 28.9. So that's kind of where we're at a couple days ago. Like I just mentioned, we've had a relief rally. The numbers aren't quite as bad right now, so we'll see. We'll see what October brings. I think it's going to be a lot of up and down. Our portfolios, growth with income portfolio, down 8% for the month. Year to date, we're down 17. Big gainers, J&J was up 1.25% for the month. Starbucks 0.25. So not a lot of winners, and when the market's down 10%, it's hard to find some winners.
Flat is pretty good.
Yeah. Companies that took hits, Nike, they had a bad earnings call. And they see some impairment to their business, especially, and they do a lot of international business. China's a big piece of their puzzle. So obviously, with the lack of activity in China, that's caused their stock to pull back 21%. Nvidia down 19%, Nucor down 19%, Digital Realty down 19%. Gainers, so that's for the month. Year to date, we still have some big winners. Exxon up 47%, shouldn't be surprising. Our commodity fund up 5%. Year to date, once again, Nvidia's caused pain in the portfolio, down 58%, Nike down 49%. So we're seeing challenges in the portfolio, but they're still good companies. Our big tech exposure really is Nvidia. Apple's held up a little bit better. Those are our main tech holdings. I think the rest of the portfolio is a little bit more balanced in the real economy, and we'll be well positioned when things start improving, or at least to avoid the worst of the downside. In dividend yield portfolio, September down 7.8%. Year to date down 15.7. Once again, dividend producers, good solid companies. For the month, Merck was up 1.7. That was really our only winner for the month. Our laggards, Intel down 19, UPS down 17, Alliant Energy down 13. So those are some of our laggards. Year to date, Merck is still up 15.2, Edison up 3%, Southern Company's up 2. So, medical. Yeah. Utilities up, defensive stocks, that makes sense. Year to date, Intel's been a big laggard in the portfolio, down 48%. 3M down 35.9. Blackstone, which is a long-term winner for us, we probably made 10 times our money on that, down 33. Fortunately, we did shave our Blackstone position significantly back in probably January, February. So, at least we
locked in some good gains there.
We took a lot of gains off the table there, so that's worked out well. It's probably helped our overall portfolio performance. Price potential, down 10%, kind of in line with the markets. Year to date, we're down 19.8, so still outperforming on a year to date basis, but definitely in this kind of washout, we're going to feel the pain. We have a lot of turnover in the portfolio. One stock was up, almost 1%. Humana, once again, a healthcare stock. For the month, CarMax got hit 25%. Lithium Motors got hit 19%. Once again, companies stocks we've made money on, but now we're giving a little bit of give back there. Year to date, what's left in our portfolio or longer term holds, Humana up 5% year to date. Big laggards, we took a position in Meta, Facebook, early in the year when it got beat down. I mean, obviously the price count still looks very good. We see a lot of upside there, but that position's hurt us. We're down about 60% in there. Comcast down 40%. So, some big losers, but, year to date we're only down 19, and at least we're making some good calls to kind of hold those up. In the small cap portfolio, September, only down 8%, year to date down 20. Here, we had a couple winners during the month. PAM Transportation up 4.2, Next Gen Healthcare up 3.3. Option Healthcare up 1.7. Once again, healthcare holds up when things are bad, and defensive play. Laggards, Rubicon Technology down 35%. Anderson's, which is more retail oriented, down 15%. Accent Industries down 16. Year to date, our big winners, that we're still holding. Lantheus Holdings still up 144%. Clearfield up 24%. So, we still have some big winners in there. Things that year to date that we're still holding, we have Stewart Information down 44%, Evertech down 6.7%, NV5 Global we're down 10. Once again, this is another high turnover portfolio. We weed stuff out if it's not working and trying to replace them as quickly as possible. So that's kind of where we're at. This month, I kind of expect more of the same. It'd be nice to have a nice positive month, another rally that can give us some relief here. But it's going to be a grind, I think, at least for a couple months here. If the Fed does what Cam's talking about, we could see the lows sooner, which also means we get back on the right side sooner too. Yep. So in my mind, I'd rather see it come sooner than later versus drag on. We kind of have to be prepared for it to drag on. But we know what's going to happen on the other side of this, and it's just a matter of getting through it, being in the right spots where we believe we are for a higher inflation environment. And from a client portfolio standpoint, the real key is, once again, holding enough money, whether it's in the T-bill positions we've been taking or cash, having enough there to make sure we can get through the valley. That's really
there will be growth again.
Absolutely.
And you just have to, these downtimes, they're not fun. You think about, people always like to say, oh, I lost so much money the last year. You haven't lost anything if you haven't sold it yet. So you just have to look at it in that vein that, since the Great Depression, it's been a lot of growth, and it just doesn't go in a straight line. You've got your ebbs and flows in it, and you just have to have the cash. You have to be in a comfortable financial position. You have to mind your debt, both personally, professionally, business owners. It was so easy the last 11 years to get caught up in things and think about all this false money and interest rates are zero. Let's buy the bigger house. Let's go on the nicer vacation. And, sometimes you need situations like this to take a step back and say, what is really important to me and my family?
Yep.
Is our financial security. Maybe not the biggest house, maybe not the best vacation, maybe not the best car because it's so cheap right now. It's saving, it's putting money away, it's being prepared, it's having a financial plan, it's being prepared for retirement ultimately so you can achieve those goals that are most important to you and your family.
The key is going to be patience. Prices will come back to us a little bit, and once again the market will come back too. So the key is not making drastic decisions. The media, is going to be even more heightened because the loudest voices are going to be the voices or the people that are feeling the most pain. So, you look at where's the news coming from, why are they so passionate in their views? A lot of it's because they are feeling the pain. They want to, try and influence and change the direction of things. But the reality is, in the long run, we look past the valley.
We got to let this play out.
8, 9, 12, 18 months from now, things are going to be a lot healthier. That's what recessions do. They're a cleansing mechanism. We haven't had one for a long time, so this is what's happening. But the other side of it is this recession, we're going into it a lot healthier than we have, especially on the consumer side, and I think the business side from a balance sheet standpoint.
Absolutely. So I know we got a little long-winded on that one, but hope you have a great month. We'll talk to you next month. Obviously, if you need anything, please feel free to give us a call. Thank you, as always, for the trust you've placed in Ellsworth Advisors.
Thank you.